You've probably heard this advice before. Just diversify your portfolio. Own lots of stocks. Spread your risk. Sleep better at night. And most of the time, that advice is right. But then something weird happens. Markets crash. And everything seems to fall at the same time. So today we're answering a question every beginner eventually asks. If diversification is so great, why does it sometimes fail? By the end of this video, you'll know why diversification usually works, when it stops working, and how to build a portfolio that survives both calm markets and chaos. What diversification actually means. Diversification does not mean owning 20 random stocks or buying everything that's popular. Diversification means owning assets that behave differently. Different companies, industries, countries, asset classes. The goal isn't higher returns. The goal is lower risk for the same return. If one investment struggles, another can help cushion the blow. That's the theory, and historically, it works. Why diversification works most of the time. In normal market conditions, diversification works because different industries peak at different times. Different countries grow at different speeds. Bonds often move differently than stocks. For example, tech might struggle while energy rises. U.S. stocks might lag while international stocks lead. Bonds may hold steady while stocks swing. When assets aren't perfectly correlated, diversification smooths the ride. Less volatility means fewer panic decisions, which is huge for beginners. When diversification stops working. Now, here's the part most people don't talk about. During major market stress, correlations go to 1. That's a fancy way of saying everything starts falling together. Why? Because in a crisis, investors rush to cash. Funds sell what they can, not what they want. Fear overrides strategy. In moments like 2008 or 2020, diversification doesn't prevent losses. It prevents total destruction. Diversification is about survival, not immunity. The biggest diversification mistake beginners make. Here's the mistake. Thinking you're diversified when you're not. Owning 10 U.S. tech stocks, growth ETFs, a crypto position. That's not diversification. That's concentration with extra steps. If everything depends on the same outcome, growth, low rates, strong economy, it will all fall together. True diversification looks boring, and that's the point. What actually helps when diversification fails? So what does help when markets move together? A few things. Time horizon. Cash for flexibility. Asset allocation. Emotional discipline. Bonds, cash, and defensive assets won't always make money, but they give you options. And options are incredibly valuable during downturns. The biggest risk isn't volatility, it's being forced to sell. How beginners should diversify correctly. Here's a simple framework beginners can use. Broad stock index funds, US plus international. Some bonds or fixed income. Avoid overloading on one theme. Rebalance periodically. Accept that losses will happen. Diversification won't make you rich fast, but it dramatically improves the odds that you'll stay invested long enough to win. The real truth about diversification. So here's the truth. Diversification works most of the time. It fails when you need it most. And that's exactly why it matters. Its job isn't to prevent losses. Its job is to keep you in the game. If this helped, hit like, subscribe, and comment survival if you want to follow up on how professionals rebalance during market crashes. See you in the next one.